morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. The attention has been on the Japanese yen. Despite Japan being one of the last countries to exit the negative interest rate policy, there has been some weakness surrounding the yen. Morning, JK, your take on the BOJ meeting and what possible impacts do you see from the from Japanese raising rates?
Good morning, Swaraj. Yes, the focus has been on Japan because they hiked the rate after 17 years. Last time they hiked the rate was in 2007. And now from negative interest rate, they have come to a zero interest rate. So that is a big change. But the change stops at that because mostly they have kept a policy on an accommodative stance. The QE will continue at the same rate as 3 billion of assets or the bonds from the market month, and they will also on an accommodative side, in the sense that they will continue to take measures which are required to keep the economy stable, and also inflation on the inflation also on target. At the same time, they might be rather they have given up buying the risky assets like ETFs. Which they will stop in the future. So for the market, what was important was that uh, differential with the US continues to be quite high. Even at 0%, it doesn't make any difference to what it was earlier because US yields are more than 4.5%. And in fact, yields in many other countries are at a much higher level. So yen is not attractive to buy. Secondly, the QE continues. And finally, the Fed meeting, which is ahead, might also sound a bit hawkish. So overall, and finally, one more thing not to ignore is the fact that the market has been anticipating a change in Bank of Japan monetary policy for quite some time. So what they did as a minuscule measure did not really warrant buying of yen, and that's why we have seen a relief rally in USD Japanese yen, which has quickly come to in the near multi-year high at 151.85. If you remember, we had seen 120, 151.90 twice in the last 1 year, and we have again come closer to that. So now the point would be whether Bank of Japan and the government officials start, protesting against the steady weakness the yen or not. But inherently, it does help the economy because their exports have been rising, and the weak yen is what the Japanese corporate also prefer. So that's about Japan. It's a small change, although it is significant in terms of historic perspective. But, for the market, it doesn't change. As far as the Fed is concerned, yes, the recent inflation numbers have given rise to expectations that their policy of rate cuts for this year might be indicating a lesser number of cuts than what they did in December. That is the dot plot, and that is where the market is slightly. In an uncertain situation. The rate cut expectation for June still stands at 57%. Now, what is important here is that while inflation has gone up in the CPI and PPI, the gauge that Fed follows, that is the PCE inflation, is not really that high. If you look at the headline PCE number, it is at 2.4%. Core PCE is at 2.8%. So from that perspective, it may not be such a big concern. And also, we have seen pockets of weakness in the economy in the recent weeks, or rather, I would say a couple of months now. Manufacturing has been on the slowdown for several months now. And then the recent employment data also showed weakness in the sense that unemployment rate jumped from 3.7 to 3.9%. Though headline job creation number was higher, the previous month's numbers were revised down. Wage increases were lower. So also the regional Fed also noted the GDP numbers going forward is likely to be lesser than what they had anticipated earlier. The 3.2% that we saw for Q4 of 2023 was, it's a backward looking data. That is not something that they would be considering. So the emerging weakness in the economy versus the CPI number or the PCE number is where the Fed's decision would be centered around. Even if they increase or rather decrease the rate cuts to 2 from 3 in their projections, market will not be unduly concerned. They're already prepared for it. But if they continue to hold on to 3, for their own assessment, according to their own assessment, then we might well see some weakness in the dollar emerging, and it is going to be a status quo. So all in all, now we are coming to a situation where in June we may well have four major central banks cutting rates. Bank of England, whose rate cut expectations are being brought forward from September to June because their inflation numbers are getting lower. Their February number will be published today, and expectation is for a lower number. ECB has almost said that in June they'll be starting to cut. Fed, if it's 6 to June, and also the Canadian inflation number, which came lower, which also brought forward their rate cut expectation to June. So at least four of them, and maybe you could add the Swiss National Bank there. So we are looking forward to middle of the year when there can be a coordinated rate cuts from major central banks. That is what the market will be, looking forward to. Yesterday's move in Bank of Japan, of course, spurred market, not only selling of yen, but also buying of risk assets in the major markets. Particularly in the US, the shares rallied in broader market of Dow up to nearly 8.83%. S&P 500 was nearly 0.5% higher. Bond yields were slightly lower, tracking the Bank of Japan move. Importantly, Eurozone also saw the ZEW number, the ZEW business sentiment, once again jumping in Germany as well as for the Eurozone as a whole, confirming slow and steady recovery for the Eurozone. So that's the reason why we found the Euro USD also bouncing from near 1.0830 to 1.0877. Added to that, the fresh carry trade by selling yen against these currencies also supported the crosses. So all in all, we are up to the Fed now to see where the risk market goes, and also where the dollar is headed from here on, based on how they project their rate cuts going forward. On the rupee, a few factors are seeing the rupee relatively weaker. One is the jump in oil prices, which is now closer to 87 for the Brent. We have the Asian currencies which weakened yesterday, particularly the Korean one, etc., which also the market was tracking, and a very subdued, or rather I would say quite a weak sentiment in the domestic stock market. Is also, although we haven't seen much of a FI outflow, but that is also kept the rupee slightly on the defensive. We have traded almost close to 83.05, which is one of the resistance points nearby. But I think if we do see more selling of INR towards 83.10, 15, central bank will get more active. So looking forward to Fed and also how the rupee behaves as we move higher. Thank you.
Thank you, JK. And of course, when we discuss the Japanese rate decision, the rate hike has happened after 17 years from negative rate to 0%. But there were some details which JK has covered. Now, the Fed meeting will be in limelight. There has been some pocket of weakness in the data in the recent months. The labor market has been weak, but the change in dot plot is something markets will be expecting. So the reaction is something we'll get to know soon. For rupee, we have been trading relatively weaker because of jump in oil prices, Asian currencies, weakness in the Asian currencies, and the weak sentiment in the domestic stock market. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.